Imagine this for a moment. You're not dreaming of a luxury mansion. You're not searching for a gated estate with marble floors. You're just trying to buy a normal house. 3 bedrooms, a small yard, nothing fancy. And yet, everywhere you look, the price tag starts with a 5. $500,000. And the most confusing part? Everyone keeps acting like this is normal. You start questioning yourself. Did salaries quietly double while you weren't looking? Did everyone else get a memo about a raise you missed? Or has the housing market completely detached from reality? Today, we're not guessing. We're not using real estate optimism. We're using math. And honest math is uncomfortable. Because there's a massive difference between being approved for a mortgage and being able to afford a home without living in constant financial stress. What $500,000 actually buys now? In many parts of the country, $500,000 doesn't buy luxury anymore. It buys average, a modest-sized house, standard finishes, a location that still requires a commute. In or near major cities, $500,000 has quietly become the entry point, not the upgrade. Now compare that to income. The median household income in the U.S. is roughly $84,000 per year. That means the typical household is being asked to purchase homes that cost 6 times what they earn annually. Historically, that ratio was closer to 2 or 3 times income. That gap matters more than anything else. The down payment reality check. Let's start where most buyers hit their first wall. A traditional 20% down payment on a $500,000 home is $100,000 in cash. Not investments, not retirement accounts, actual accessible money. The typical American household doesn't have anywhere near that. Most don't even have a fraction of it. So buyers do what the system encourages them to do. They put less down, 5%, 10%. And while that feels like a workaround, it introduces a hidden cost: private mortgage insurance. PMI is a monthly fee you pay because the bank considers you risky. It doesn't protect you, it protects them, and it often adds hundreds of dollars per month to your payment before you've even moved in. The real monthly cost, not the one advertised. Let's walk through what owning this house actually costs. With a modest down payment, you're financing roughly $450,000. At today's interest rates, your base mortgage payment alone lands close to $2,800 per month. But that's just the starting point. Now add property taxes, homeowners insurance maintenance, and repairs PMIHOA fees in many neighborhoods. Suddenly, your mortgage becomes a total housing cost north of $4,000 per month. And that's in a good month, when nothing breaks. What income makes this comfortable? Financial guidelines exist for a reason. Conservatively, housing should consume no more than about 28% of gross income. Banks are willing to stretch buyers much further, but banks are measuring default risk, not quality of life. If your housing costs are around $4,300 per month, that math points to an income well above $150,000 per year just to avoid being house poor. That instantly excludes the majority of households. This isn't opinion, it's arithmetic. What happens to high earners? Now let's look at a household doing better than average. 2 professionals, strong careers, combined income around $160,000. On paper, they should be comfortable. But after taxes, benefits, and basic retirement contributions, their actual take-home pay shrinks dramatically. Once the housing costs come out, nearly half of their usable income is already gone. What's left has to cover transportation, insurance, food, utilities, student loans, medical expenses, emergencies, savings. There's very little breathing room. One unexpected expense doesn't cause inconvenience, it causes panic. The psychological cost. No one talks about this is where affordability stops being theoretical. It's not about spreadsheets anymore. It's about checking your account before simple purchases, delaying repairs because the timing is bad, carrying constant anxiety about job stability, feeling trapped in a house you technically own but can't enjoy. This is what house poor actually feels like, and it's becoming normalized. Why the system encourages this? Here's the uncomfortable truth. Every major player in the home buying process benefits when you stretch. Lenders earn interest, agents earn commission, insurers earn premiums. No one gets paid for telling you to wait, downsize, or walk away. Approval is treated like affordability, even though they are completely different things. The bigger picture. Housing prices have dramatically outpaced wage growth over the past few decades. That gap is the real issue. No amount of budgeting hacks can fix a structural mismatch between income and prices. And yet, people internalize this as personal failure instead of recognizing a systemic problem. What actually builds wealth? Here's the part that gets lost. Wealth isn't ownership at any cost. Wealth is margin, flexibility, stability. It's being able to save, invest, and absorb shocks without panic. A house that consumes your entire financial capacity doesn't build freedom, it removes it. The honest question to ask. The question isn't, can I get approved? The real question is, will this decision make my life better or more fragile? For many people, when the numbers are honest, the answer is clear, even if it's uncomfortable. There is no reward for buying a home that keeps you awake at night. Closing. If you're feeling priced out, you're not broken. If the math doesn't work, you're not irresponsible. You're responding rationally to a market that no longer reflects reality. Sometimes the smartest financial move is saying no, not forever, but for now. Because the goal isn't just to own a house. The goal is to live a life that isn't dominated by financial fear. And for most people today, that $500,000 house doesn't deliver that, no matter what the approval letter says.